Welcome back, guys. Today we're going to take a look at Spotify. Spotify is a giant podcasting platform. They do music and stuff. You subscribe to it, and then you get a bunch of audio stuff. Anyways, the 5-year chart is 146% up. That's very solid performance. You can see how volatile it is. It was up at $350 a share, and then it dropped all the way down to like $80 a share. Absolutely crazy volatility. And now it has came roaring back. So how did this happen? Well, it happened because their margins, pretty much. Their market cap is 61 billion, and right now they don't have any earnings. But see, you could see the past 5 years, they haven't really. Oh wait, past 5 years was pretty much a loss. Yeah, a loss every single time. However, so people were wondering if this company would ever turn a profit. And in the last quarter, they did turn a profit of 5%. So that made investors very happy. You can see, let's take a look at the financials here. We can see the revenue growth has been stellar. Basically, they just get more subscribers and then they end up paying more. And that's how the revenue grows. And most people, once they get a subscription, they most likely don't cancel. So it just keeps going up. And in terms of their gross margins, well, the gross margins are very consistent because a lot of times they pay the artists for their music for each watch, and so that's going to be what those costs are. And then they were able to turn a profit because last quarter they actually cut some of their expenses. So here you can see the research and development was going up and up and up, and same with the selling and admin. However, last year it went down a little bit. And in the first quarter of 2024, they were able to cut their R&D expense and they were able to cut their selling and general administration expenses. And so that's why their margin was actually 5%. Can we expect that to continue? Well, I would expect probably 5%, and then maybe next year, maybe they get it to 6% or 7. But I don't think they're going to get like crazy margins or anything like that. I think that they're going to stay below 10% margins. And yeah, so they actually had some income. However, they've been diluting shareholders through stock-based compensation because their cash flow is good. Their balance sheet's very solid. They have negative net debt, and they've got lots of cash on the balance sheet. Cash flow, yeah, they just issue some stock, but they also do stock-based compensation. That's why their cash flow is so good. Cash flow is positive, like every single year, but their earnings are negative. In terms of their stats, we could see their gross margins. Gross margin is 25%. Yeah, very, very consistently about 25%. And then the net margin has been negative except for last quarter. Taking a look at this, yeah, they've got their premium subscriber growth. And actually, it was kind of interesting. They actually have a lot of subscribers in Europe. They have more subscribers in Europe than they have in North America, which is kind of interesting. I didn't really expect that. And then Latin America and the rest of the world for premium subs. And monthly active users are quite high in the rest of the world, so maybe they'll eventually charge those users with premium. Let's take a look what the analysts think. The analyst projections are $5 a share going up to $7.27, and the revenue being at 17 billion going up to 19.4 billion in 2025. That's a 20% increase this year and a 14% increase next year. In terms of their stats, let's look at their short percentage. Short percentage of 2.3%. That's not terrible, especially for such a volatile company. They are in an uptrend right now, so I do think that you'd have to be kind of crazy to short this company. There's a lot of it is held by insiders. You can actually look at holders here, I guess, and see what this looks like. At 26% is insiders. Check insider transactions. Looks like there hasn't been much activity with the insiders. Let's take a look at my model now. Here's my model. Let me see if I can get the zoom correct. Okay, there we go. So it looks like, what kind of zoom is this? But okay, Spotify, I put the estimates here. Buybacks, they don't do any, negative debt, and discount rates of 10% because I want a 10% return on all my stocks. Exit multiple 25. I think this is fair because as long as the company is able to generate a solid margin, then they do have long runway for growth. Their balance sheet is great. They have some networking effects. The larger they grow, the more content they can put on their platform, the more money they can make. So I think an exit multiple 25 is fair. And in terms of growth, I have their earnings growth at 14%. Usually it's tougher to value companies that have expanding margins with the earnings model. So I prefer to look at this revenue margins model. And with this model, I have the analyst projections at 14% and slightly declining from there down to 10%. I think that this is pretty optimistic. Yeah, they have slowed down to 7 or 8% in the past. I think 10% is totally fair. Maybe they slow down to 6% at some point. And in terms of profit margin, the analysts are projecting 6% this year. I think that's okay. And I think that they will slowly expand this up to maybe 9% in 8 years. I think that's totally reasonable as well, especially if their revenue is this good. And then they are able to cut expenses, and I think they could get their profit margin up to 9%. And in this case, we could see that they're overpriced at this time, the fair share price being $250 a share. With them trading at 310, they are overpriced at the moment. And I think this is kind of optimistic. It's definitely possible that they slow down quite quickly to 6% revenue growth because they have come out with tons of new products, and I think that's why their revenue growth has been so much higher in the past couple of years or past few years. But I think that they are running out of new products to launch. And so I think their growth is going to slow down here. And their profit margin, yeah, I think this is fair for profit margin. I do think that they'd probably be worth about that. And I'd say if you bought them today, you'd probably be expecting like a 7% return. Yeah, maybe like a 7 or maybe like a 5% return. Yeah, I'd say 5% return you'd be expecting. It's okay. It's not amazing. It's too bad that you weren't able to pick them up when they were way cheaper, right? Around this point right here when they were at this bottom at $80 a share. However, at this time, we didn't know whether this company was ever going to turn a profit. So, I mean, it makes sense why it would be trading around that point. But now that they have turned a profit and they've proved that they can, now it trades at a premium. So, I mean, it makes sense. But yeah, that's my thoughts on this company. Let me know what you guys think in the comments. And make sure to hit that like button. I'll see you in the next one.